There are a couple different cycles that kind of overlap. One of them could be considered the long-term debt cycle. So debt builds up in the private sector, then generally gets transferred more toward the sovereign level, and then gets basically debased or inflated away. That's kind of one big cycle that developed economies go through in modern history on something like an 80-year cadence, but it can vary. And then just more broadly, there's this kind of imbalances that build up in any sort of complex system, the way that these are currently constructed. And so even between those, say, 80-year periods, there's usually like a midpoint where things change. So for example, the midpoint between the past kind of long-term debt cycle, which was the 30s and 40s, and the current one was the early 1970s. That was a different type of default, a different type of monetary change. And so I agree with you that this is kind of a historic moment. I don't know if there's a specific date that's going to stand out quite the same way. Maybe Liberation Day, maybe another time will we pick. Maybe the moment that Russia invaded Ukraine and then there are all these sanctions triggered, that, maybe it's just the pandemic itself that was kind of catalyst for a lot of things as well, fiscally speaking. So I don't know exactly what date or period will be highlighted as like the points, but I do think that this era will be looked back upon, much like the 70s, much like the 30s and 40s, as a time of change in the way that the global monetary system is constructed and the way that a lot of domestic finances work. If you look back to the early 1970s, when this was current kind of floating exchange rate system really began, there's really only been $3 cycles. So major periods of dollar strengthening compared to other currencies and then weakening compared to other currencies. These have had very big investing implications each time. Generally speaking, when you have this kind of weaker dollar periods, you're looking at more inflationary periods, you're looking at more value stock outperformance periods, you're looking at more international stock outperformance periods. Whereas when you're looking at the stronger dollar periods, you're generally looking at more disinflation, you're looking at more growth stock outperformance, you're looking at more US stock outperformance. And so we have been in a strong dollar environment for quite a while now, since about 2014. And should we get another leg lower in the dollar, either just due to policy flow shifts, kind of like, say, the early 2000s dollar bear cycle, or a more intentional dollar bear cycle like 1985 Plaza Accord, we could have a Mar-a-Lago Accord. That has a variety of major investing implications, but it's not necessarily a structural change in how the system works. So I do think that we could certainly be geared toward something more than just that, because some of the things have been building up for a lot longer than just, say, a dollar cycle. But that is kind of one key thing to watch for any of us that are involved in markets or, follow the prices of assets we own. So that is a key thing to watch. Many cases, global M2 will be measured in dollars because global M2 has a bunch of different units, so all the different units of the major currencies. And so when you're kind of reporting what is the value of this figure, it's normally reported in dollar equivalents because that's the global reserve currency. And the reason it's really relevant is because out of all the major currencies, the dollar is by far the most important cross-border funding currency. So there's something like $18 trillion worth of dollar-denominated loans and bonds that are cross-border in the world. It's the unit of account for liabilities, which is really important. So when the dollar is weakening, it means various entities around the world, their liabilities are weakening, which is good for them. Whereas when the dollar is strengthening, their liabilities are hardening. It's like if you took out a mortgage in Swiss francs, but say you're renting it out and all the cash flows are in dollars, you're in a world of pain if the Swiss franc doubles compared to the dollar, whereas you're doing great if the Swiss franc gets cut in half relative to the dollar. That's what happens kind of the whole world. And so whenever you do get that weaker dollar environment, you get a surge in global M2, but it's mainly because the denominator is going down. But then also what that does is that allows emerging market central banks around the world to kind of loosen a little bit, because during strong dollar environments, even if they encounter a recession, they often have to be pretty tight with their monetary policy to avoid currency crises. And so when they do get that weaker dollar period, they're able to kind of actually stimulate for a change. And that's when you tend to get that little bit of a rotation. I think what they want more is like higher capital goods. When we look at China, for example, that's the trade boogeyman at the current time. They've moved up the capital stack. So we used to think of China as the biggest producer of like plastic goods, for example, and textiles. A lot of that has rotated toward less expensive manufacturing places than China, whereas they've moved up the capital stack. China is now the biggest exporter of vehicles in the world. They've passed South Korea, Germany, and Japan as the biggest exporter. And it's not just, like electric vehicles, it's actually mostly ICE vehicles. Like when I bring bring up Egypt again, the streets just have tons of Chinese cars on them. And that's true for a lot of developing countries in the world. We don't see them in the US, but you see them in a lot of other places. And I think several entities in the US kind of want that for the US. They want to be a semiconductor manufacturing area. We want to be leaders in robotics. We want to be a leader in all sorts of kind of higher end capital goods, rather than kind of having give that industry up to Europe and East Asia. And I do think it's bigger than just trade, because the point that I've been making a lot is that the current issues with US trade specifically are heavily tied to the global monetary system as it's structured. So going back to my point that, every several decades, these things tend to change pretty substantially. This is potentially more than just a trade cycle. Part of why there's so many entities even talking about a monetary change or a change in structure is because it's so tied to trade. And a point that I've made is that basically the other side of being the global reserve currency is something in your economy is generally getting hollowed out. There's some sort of imbalance that's kind of embedded into the system, and you're kind of paying this cost to maintain the privilege of being the global reserve currency. So back in the Bretton Woods era, the cost was that we were draining our gold reserves. We had pegged the dollar to gold. A bunch of other currencies pegged themselves to the dollar, and then the dollar was the primary global funding currency. So the combination of fractional reserve banks and deficit spending made it so that the number of dollars kept increasing dramatically, but our gold reserves were not. Right. And so over time, as you get more foreign redemptions, our gold reserves fell from 20,000 tons to 9,000 tons, and then they quickly defaulted on the ability to redeem dollars for gold. And ever since then, when we shifted more toward the euro-dollar system, petrodollar system, instead, kind of the cost that we're paying is deindustrialization. We are gradually hollowing out our industrial base to maintain our kind of global dollar empire. But this has cumulative imbalances. We're constantly taking away from Michigan and Ohio and Pennsylvania and the Rust Belt and making it get the name Rust Belt. It's going then international, and then they're reinvesting their proceeds in U.S. stocks, U.S. bonds, private equity. So that's going back into New York, back into Silicon Valley. And so kind of the net result is we're taking out of the Midwest and we're sticking the value into the coasts. And so you get both domestic political issues, and then you get these kind of global big imbalances where China has all these massive surpluses, the US has all these massive deficits, and other countries kind of sit somewhere in the middle. And that's kind of an artifact of the system that we've structured. And the challenge is that if you want to bring back some degree of manufacturing and industrial vibrancy, it generally comes with the cost of giving up some degree of the currency power that they have. Well, in Stephen Meyer's paper, he talked about if what he's saying is basically ends up happening, it'd be beneficial for gold and cryptocurrencies, which would primarily be Bitcoin. He used the phrase cryptocurrencies, but basically gold and Bitcoin would benefit from this more neutral reserve asset type of system and a more multipolar system. Then you see a little bit of pushback from within the same administration, because, for example, Trump would say that if there's an attempt to make a BRICS currency, he would stop it or try to, he would sanction it and things like that, even though that would actually kind of play into the Myron playbook to say, okay, let's some of that, foreign trade happen in a different currency. Now, I think for separate reasons, a BRICS currency doesn't make sense, but basically one of the potential paths for reshoring some of the higher end U.S. manufacturing is to say, look, if China wants to do trade, they're already the biggest trading partner with most countries, they could do more of it in their own currency. They can do more cross-border funding in their own currency, not have it always be the dollar. And that actually allows some of the imbalances to shift a little bit. So instead of the dollar being, 90% of currency exchange, by far the biggest cross-border funding currency, bigger than all the others combined, you can have a potentially more multipolar world where the dollar remains central in certain parts of the world, and other parts of the world, it becomes, the Chinese currency, and that the biggest reserve assets become, the neutral ones that are not issued by any one country. So it's not as though there's no world where really another country becomes the global reserve currency issuer in the way that the United States has been. That's not really in the cards for anyone. It's more like, how quickly are we going to shift toward a more multipolar system and one built around neutral reserve assets? Or to what extent are we going to fight that shift? And I think the more elegant approach is to let that shift happen and make sure that we're kind of benefiting from that shift rather than fighting it. It's kind of like if you realize you're the Roman Empire, you've maybe spread your borders too thin, so you're kind of too wide, and now you find yourself doing tons of border skirmishes and realizing that you're facing issues from such a big empire. The question is, do you keep fighting every inch of the way to keep your borders, which is probably not the best approach? Or do you kind of strategically assess, okay, which borders don't make sense anymore? How can we come out of this really strong from a position of strength? And I think you can do that with currencies. One of the things that Myron proposed was trying to get foreign holders to term out their debt. So basically to say hold fewer T-bills and 2-year T-notes and things like that, and how to get them to buy potentially newly issued 50-year bonds or century bonds, for example. Whereas stablecoins need the opposite. They generally need pretty short-term collateral, or you're potentially risking a pretty big mismatch of assets versus liabilities. Right. And so if anything, I mean, that increases the appetite for T-bills and maybe potentially other fairly short-term treasuries. It's not functionally that much different than reserve holdings. It's kind of the money of the people rather than money of the central banks. We do see kind of a gradual top-down slight de-dollarization, whereas you don't see that on the bottom up. Generally when you go to the black market in Cairo looking for money, it's the dollar. Less so the euro, less so the Chinese yuan. Right. Even though China is the biggest trading partner with Egypt compared to the US, it's still dollars that are desired. And so there is a lot of bottom-up demand for stable coins and by extension T-bills. It doesn't really conform with Myron's plan of either getting the foreign sector to invest less, or to the extent that they're going to invest, to term out their liabilities to potentially reduce long-term interest rates for the US.